We're going to bring in Jeff Middlesworth. Jeff is the president and director of research at Behind the Numbers. This is an independent research firm that specializes in reading between the lines of company financials for institutional investors as well as hedge funds. He joins us now from Dallas. Welcome, Jeff. Always great to have you here on Fast Forward. You were last on, by the way, July 8th. Good time to be shorting stocks because I was looking at the S&P since July 8th, down about, 10% over that period of time, which is a pretty big jump on an annualized basis. You just heard Adam there, Jeff. What do you factor that in when you're looking at particular companies to short?
Oh, definitely. Short interest is huge. Not only is it hard to borrow the stock, but you end up with a situation that the volatile movement is just too much to deal with. We much prefer to stick with names that are low short interest, that are really off the radar screen, and look really for just broken companies. If it's a real company with a high short interest, we just don't want to be involved. It's too short term for us, and we're much more of a fundamental analysis view than looking for something on, next week it could miss by a penny, and we're going to be in and out of it in 6 days. Right,
and in that context, then, I know two of the companies that you like to short right now would be Goodyear Tire and Charter Communications. Makes complete sense because both of these are up year to date.
Yeah, I mean, for us, companies that are shrinking, that are seeing kind of just a slow erosion and have lots of debt, just make great shorts. You can keep them on for a long time, and the business fundamentals just never really seem to improve. When you look at Goodyear, this is a company that is kind of the poster child for why EBITDA is something that people will rail against how aggressive it is. Goodyear's cash flow over the last 10 years has been 90% due to lowering working capital. The company produces almost no cash flow on its own. And the problem they've got going forward is that all their working capital inputs, inventory, raw materials, energy, that type of thing, is all rising in price. So working capital is going to start consuming cash for them. They still have to pay their pension, which is massively underfunded. That's going to consume cash. They can't raise prices. Cooper Tire announced a couple weeks ago that they tried to raise price. Everyone bought tires ahead of time. Therefore, their sales going forward are going to come down. They're going to see margin squeeze. And Goodyear's suffering the same problems. This company sells less tires now than it did 10 years ago. The world travels a lot more in cars than they did 10 years ago.
Hey,
so
Jeff, I gotta ask,
it just continues to shrink.
I want to get to Charter, but before we do, let me ask you, when I'm looking at the sell side, analyst ratings on, say, a Goodyear or just about any stock, really, there's always considerably more buys than there are sells. In Goodyear's case, 8 buys, 2 holds, 1 sell. What are those analysts missing?
They're basically looking at it and saying that, it's a leveraged company, and therefore if you get some improvement in the economy, they will see an uptick in demand, and all that value will flow to the stock. They're also looking at it saying, hey, this company is restructuring, they're going to save money, they're going to shrink headcount, they're going to shrink their capacity size and operate more efficiently. And in my mind, what they're missing is this is round 5 that Goodyear has done this. They have been restructuring now for well over 20 years, and it's always the same plan.
And then Charter Communications, year to date, this stock way up 27%. But this is when you say sell. This is a new one for us.
Yeah, the interesting thing with Charter, it's already been bankrupt once, and now it's still carrying 5 times EBITDA in debt. I'll even use the aggressive number. The problem it faces now is monopoly. There's no longer monopoly in cable. They're having to compete against satellite. They're competing against AT&T and Verizon, who have taken big share out of their customer base. So they're shedding customers every year. And in fact, customers have gone from about 5.7 million to about 5 million over the last few years. And that's been masked by a couple things. One, it's been masked by people upgrading from basic cable to digital cable, where you can charge more. And it's been masked by people going from dial-up modems to high-speed internet, where, again, you can charge more. And the problem is both these trends are pretty far along, and you're just not adding enough new people to offset the ones you're losing. And at the same point, with AT&T and Verizon and Dish and everybody else, they can't raise price anymore. So they have an annual programming cost increase of about $100 million. And without price increases and without more people switching from digital from basic to digital, they're just seeing a net loss in total operating income from this kind of stuff.
All right,
and
Jeff, I got to jump in. Unfortunately, we got to leave it there, but it's always great to have you on, take a very contrarian look and one that's worked out pretty well since the last time you were on. So shorting Goodyear Tire, Charter Communications. Thanks so much, Jeff. That was Jeff Middlesworth of Behind the Numbers.